Welcome to this very interesting session. Investing has always been a long-term, very rewarding and fruitful journey for everyone, right? But with investing in especially equity markets, it's also associated a lot of risk of the short term of the uncertainties that are coming with the equity markets, right? But we also know that yes, if you want to create wealth in the long term, equities is perhaps one of the best asset classes that have helped created wealth in the long term. It's not only in India in the last 30 years, you have seen it, even if you see across the world, like in the US also, if you see they've got a track record of more than 50 to 100 years in the equity markets, right? And where we have seen long-term wealth happening over a long period of time. But here the question that has arisen, and especially we look in developed countries such as the US, is that when I'm outsourcing my money, right, to be managed through the mutual fund route, the costs that are there, sometimes people always question about the cost, that is it worth paying so much money to the fund manager to manage our money or not? And this was the same question that was asked in the 1960s and 1970s in the US markets by some of the most renowned experts and academicians whom they did research, and they found out that in the long term, after deducting the fund management expenses, more than 85-90% of the actively managed equity funds were unable to beat their benchmarks in the US. And that is where this concept of index funds or passive funds came across, where the fund manager's job is to just get money, mimic the index at a very low cost. Today in India, we have got almost a 25-year track record, 25-year plus track record of equity mutual funds in India, giving extremely good returns, right? And they have been consistently beating the benchmark also. But of late, we have also seen that the equity markets get extremely volatile. And there have been instances where we have seen some of the funds not being able to outperform the active fund, not being able to outperform the benchmark. So here also the question has arisen that is it time for investors to shift more to the passive funds or more to the active funds? Right. And if you see also a lot of corporate money, for example, the EPFO, which is one of India's largest investors, have started investing in the markets through passive funds. Right. And you're also having a lot of institutions coming up, new AMCs coming up who are more focusing on the passives and rather than actives. So now to more clarity about the passive side, whether it is better to invest in passives or actives, we have got to ask Mr. KR Hariiharan, who is the Vice President and Head Training of Access Mutual Fund. He has over 17 to 18 years of experience in the financial market space across various organizations such as Reliance Mutual Fund, ICICI Securities. So I would hand over the video to him to take over, sir. So over to you.
Thanks, Niranjan. So namaste, namaskar, and good evening to all of you. Welcome to yet another webinar, this time around passives and more specifically about index funds. So just give me a moment. Let me just share the presentation now. Niranjan, can you confirm if the slide is visible?
Yes, the slides are visible, sir.
Okay, great. Thanks. So let's get started. The topic for the webinar is index funds and Access Mutual Fund is the house of index funds. So I'm going to spend time on index fund, but before we get into index fund, we will understand something about passive investment, why it is important and relevant, and how does index fund sort of fit into your mutual fund portfolio. So let's get started. Before I get into the index fund per se, it's important to quickly look at what is happening as far as the passives are concerned. And if you look at it over the last few years, there has been a lot of money that has now started coming into passive mutual funds in India. And there are valid reasons for the same. Some of these could be due to the fact that a lot of institutional money flows into passive. Some of the so the Provident Fund, which is run by the EPFO, is mandated to invest in passives, and you see a lot of these money flowing into passives. But what is alarming and interesting to note is that if you look at the assets in the passives over the last 3 to 4 years, and I have some data on this slide, March 2020, the entire passives bucket was about 1,65,000 crores. March 2023, this is shot up from 1,65,000 crores to about close to 7 lakh crores, which is almost more than close to 4 times and more than 4 times of the assets that were in 2020. Interestingly, within the passive space, if you look at it, index funds have garnered a significant proportion of the share. Index funds assets were only about 8,000 odd crores in 2020 March. And as we speak, it is close to about 1,70,000 crores. So this is a significant jump in index funds. In the last 1 year itself, from 2022 March to 23 March, index funds have grown by about 144%. And if you look at the annualized growth from 2020 till 23, it translates into more than 110%. That's a significant amount of money that's flowing into passives, and especially in index. Now, while I said that there are reasons for the same in terms of institutional money, I also want to bring something very interesting as far as index funds are concerned. The fact is that out of the 1,67,000 odd crores that is there in the index funds, roughly about 88,000 crores is the money from individual investors. And this includes your HNI and retail. And why I'm stressing about this is that a lot of you, as part of today's attendees, would also already be investing in index. You might be investing in active mutual funds. And again, the thought or the perception that general investors have is that index mere liye nahi hai. Index to institution ka kaam hai. Mere liye to active funds hai. While it remains true, but I will dwell upon why index fund becomes an important component and how it can become an important component in your overall portfolio. So the fact is, a lot of retail and HNI investors are investing in index funds. Okay. So with that context, let's get started in terms of what passives are, how do they work, so on and so forth. Okay. Before we get into index funds in more details. So let me explain this with a very simple example and something, whenever we look at ice creams, for example, I'm sure that most of us, given a choice, even after we have had a very sumptuous lunch or a very heavy dinner, if somebody were to just casually say, ice cream kha lete hain, I think most of us would be ready for it, right? और हम कहीं ना कहीं बोल ही देते हैं आइसक्रीम के लिए तो जगह बनी जाती है. So there's always this room for an ice cream. And let's assume that you want to sort of enjoy this ice cream. There are two choices in front of you. One is that you could go to a outlet, which could be an Amul outlet, for example, which is just close by to your residence. And when you go to an Amul outlet, you obviously get the authentic Amul ice creams there. And there are various variants of the ice cream. You have the tricones, you have the tubs, you have the family packet, etc., and so on and so forth. And within each of these variants, you could have different flavors of the ice cream. And this, if you were to go to a Amul ice cream show outlet in Mumbai or a Delhi or a Chennai or an Hyderabad, wherever you go, you will find that the products are extremely standardized, isn't it? That the experience will be very similar, the price will be the same, the ambience will be very same, will be very, very similar. The taste, obviously, one would expect would be the same across all Amul franchises and outlets. So what I'm trying to say is that this is a very standardized option of having an ice cream where irrespective of which location, tier 2 or tier 3 or tier 1 town or city you go to, if there's an Amul outlet, you would expect a very similar kind of experience, taste and flavor and choice of products that is available, right? So this is what we call as a standardized variant. And from an investment perspective, this is nothing but the passive style of investment, right? So passive style of investment is a very standardized offering from an investment standpoint. And I will explain some of these in more detail. The other option when you want to have an ice cream is that you can just go out of your society, walk for a few meters, and you would find that there is a local street ice cream vendor, or you could get into a local restaurant which is close by who also sells ice cream. Now, when you go to such outlets, which could be a local street vendor or your restaurant, you would find various options available. You could have branded ice creams, you could have non-branded, their own locally made ice creams. All of these could be available. And what it offers to you is that you could tell this local street ice cream guy that mujhe दो फ्लेवर एक साथ मिक्स करके देना, give it one scoop of one flavor, another scoop of another flavor, right? So what you're doing in a way is you're sort of customizing your preference for the flavors, right? So this is what happens when you go to a local street ice cream vendor. You get variety of combinations that can be possible, and so on and so forth. The ambience obviously will be very different. You go to a local street guy versus you enter into a restaurant, the experience could be different, the service could be very different, the cost could be very different, right? So this is an offering which is very customized in nature, in the sense that you pick and choose what flavor, what combinations you want, so on and so forth. So this sort of represents the active fund management, where the fund manager tries to select stocks, okay, and then constructs a portfolio. So the earlier bit was the standardized format, which is a passive investment. This is an active format where there are actively managed mutual funds. So the next question that comes to mind is that if there are both actives and passives, which is better? And to explain that, let me use this illustration again, something that all of us could relate to. Many years back, you only add the manual transmission cars, right? When I say manual transmission cars, you had to change the gears manually, right? And as a driver of that vehicle, you were very active in the sense that you were very conscious of which gear you're changing. You're pressing the accelerator or the brake, and when you change the gear, you also have to press the clutch, and so on and so forth. So it's a very active way of driving. Then a few years back, came the concepts of automatic transmission cars. And what automatic transmission cars gave us is the option that instead of you changing the gears every now and then, you could put the vehicle into one mode, which is called as a drive mode. And the moment you put it into a drive mode, there's an automatic gear shift. You don't have to manually change the gear. So now what has happened as a driver now of that vehicle, while you're still conscious and active in terms of using the brake and the accelerator at the right time, the gear change happens automatic. So in a way, you have sort of have a mix of both active and passive style of driving now. Few years back, we had another interesting facility that started coming up in some of the SUV vehicles, which was the concept of a cruise control. Now, what happens here is that you are on a highway, you're going on a Mumbai-Pune expressway or some other expressway, and you see that most of these expressway have got speed limits. So let's assume that's an 80-kilometer speed limit. So while manually you can still do that, but you're very conscious of the fact that are you over speeding, etc., so on and so forth. In a cruise control, you set the speed at 80, and now you're absolutely hands-free, except the fact that you will have to just sort of control the steering. So now the same driving is completely shifted to almost passive, right? So actively you're just sort of controlling the steering. Rest everything is going on an autopilot mode. So these are various variants. While all of these variants have come, the fact also remains that we still continue to have manual transmission vehicles. We have auto transmission vehicles. We also have the cruise controls. And all of these still coexist. And that's precisely what I want to tell, that both in a city traffic, one would prefer having an auto transmission car because you don't have to constantly press the clutch and change the gears, right? So depending on the requirement of the driver, traffic, and the place where you're driving, the choice of vehicles could vary, right? Somebody is more frequent in terms of going on highways would prefer the cruise control feature, while in a city it doesn't make any sense at all, right? So in a way, active and passive also has their own set of customers, who would prefer active style. Customers could prefer passive style. But just for the time being, I want to leave behind this thought that both of them, just like all these facilities in a car, could coexist, and which is what we want to communicate, rather than saying that active is better than passive or passive is better than active. We want both of them to coexist, and we will discuss on how both of them can coexist in your portfolio, right? So let's get more into the details of what passives are. Quickly, we have sort of in a way explained it. So it's an investment vehicle that sort of aims to copy the performance of a particular market index. Please remember, it's a very important word here. that they will want to copy the performance of the index, and therefore the fund manager in a passive mutual fund does not try to beat the market or does not try to outperform the market. Instead, the objective is very clear, that they want to generate returns which are very close to or match the returns of the index. And by virtue of that, because the fund manager here is not going to do extensive stock research, so on and so forth, in a way it helps the investor, because passive funds therefore have lower costs, because they don't require that kind of extensive research and stock selection and frequent trading also, because basically you're just going to copy the index and keep it at that. So the churning does not happen as high as what would happen in an actively managed fund, and therefore the transaction costs could also come down, and therefore the overall expenses get reduced. That's one of the biggest advantage of passive funds. So from an investor standpoint, passive funds offer the investor the choice, a very cost-effective choice in terms of accessing the market and diversifying the portfolio to get exposure to a broad range of market segments. And we'll explain this broad range of market segments in some time. So within passives, there are two main types of passive funds. One is an index fund. The other is an ETF, which is an exchange traded fund. For today's discussion, we will limit most of our talking points to index funds, right? So what is an index fund? An index fund is an open-ended scheme. And what do we mean by open-ended scheme? कि investors में कभी भी आ सकता है, कभी भी जा सकता है. So investors can enter and exit at any point in time. And because it's a passively managed fund, index fund will track the underlying benchmark. So let's understand this with an example. Let's hypothetically assume that there's an index which has got these various securities, ABC, PQR, XYZ, and DEF. And all of these have the weightages also. So ABC security in the index is at 10% weightage. And PQR has got 9, 7, and 5, and so on. So what the fund manager who is replicating this index will do is he will construct a replicated fund. And in this fund, he will also have the same securities. So he will have ABC, PQR, XYZ, DEF, and in the same proportion as is there in the underlying index. So out of 100 rupees, the fund manager will put 10 rupees in ABC security. Out of 100, he will put 9 rupees in PQR. So he will just going to copy, mimic, or replicate the underlying index. So that's the job of the fund manager in an index fund. And of course, the fund manager could have some amount of cash component as well. So but broadly, the objective and the intent is to exactly mirror what is there in the underlying index. And therefore, when you look at index funds, these are passive funds that replicate the performance of a specific market index. So they will invest in the same securities, same proportion as is there in the underlying index, and it provides investors an opportunity to gain exposure to the broad market or to the sector. For example, if you were to look at an Axis Nifty 50 index fund, as the name suggests, Nifty 50 index fund, which means the fund manager in this particular fund will invest in the Nifty 50 index. So he will invest in the same 50 stocks as is there in the index and in the same proportion and weightage as is there in the index. So he just copies the same 50 stocks, creates a portfolio. Right? So as simple as that. That is what index fund does. The advantage is by taking exposure to 50 securities, you're in a way as an investor getting exposure to the top 50 companies of the country. And you're getting a representation of different sectors and industries that become part of the 50 companies, right? So we are getting an exposure to the broad market, by participating through an index fund. Now, what's the beauty of index fund? What are the advantages? We'll understand. When you look at index funds, the one thing that quickly comes to my mind, is from mythology. And if you were to recollect, Ramayana, where Lakshman is felled, and he falls unconscious, and Vaidya says that, somebody has to go to the Himalayas and get the Sanjeevani booty. So and they decide that Hanuman is the best person to go there. So we'll not get in the story of all that. But when Hanuman reaches the Himalayas, he figures out that, he's been told which herb has to be picked up. So he has been told that Sanjeevani herb looks like this. This is what you're supposed to pick up and come. But when he reaches there, he finds it very confusing. So सब कुछ same ही लग रहा है. And he is confused now, which is Sanjeevani, but he does not understand. So which one should he pick? Which one should he not pick? Is the question in his mind. So what he decides is that because time is also important, it's not that you come back and check and go back. It's not possible because you're supposed to get it before sunrise and so on and so forth. So Hanuman quickly thinks of an idea. He says that instead of me picking and choosing, let me just pick the mountain itself. Right, and he picks up the entire Dronagiri mountain and he brings it and gives it there, and then the Vaidya picks up the Sanjeevani herb. So instead of doing the pick and choose, this is what index fund also provides. So index fund is you're buying the entire basket, you're buying the entire mountain instead of selecting that particular herb. Right. So what index fund therefore provides is something very, very fascinating and interesting from an investor's perspective. First and foremost, it gives investors the flexibility that they can get out of the business of guessing ab kya hone wala hai, right? And this is what typically is in the mind of every investor who invests in the equity markets. Ki bazaar kya lag raha hai, kya hone wala hai, right? So it sort of, in a way, helps investors to move away from this entire thought process. Why? Because as an index, one would expect and believe that, in the Indian context, the index is expected to perform very well in the medium term to long term, and there are various reasons and data points that support it. While I will just briefly touch upon some of them, we'll not get into too much detail there. It also helps investors to say these magic words, and the magic words are, I don't know, I don't care, right? Now, what do I mean by this is that, so again, if you go back to that Hanuman example, you go there to figure out which herbs to be picked up. It's a choice that you make. And if you end up picking the wrong herb, in that situation, it's a question of life and death. In the investment context, there are so many companies that are listed. And while the active fund manager, with all his experience and expertise, will pick the stocks and the businesses and the sectors, the question always in the mind is, which sectors and industry should I pick? And within those sectors and industry, which stocks or businesses should I pick? So there's always this choice and that decision making that happens, when it comes to active fund management. In an index fund, I don't care because I'm going to buy the entire basket. And I know which are these companies because those indexes already created, right? So I don't know, and I don't even have to care about what is there in the underlying index. The third important element, again, very important from a behavioral perspective, is that when you look at investment options, and there are different styles of fund management, broadly, there are two main types. One is called as a growth style, and the other is a value style. Okay, and both of them are very different in terms of the approach towards stock selection. Now, what happens is very important for us to understand that both these styles, value style and growth styles, have their own cycles. So, kabhi growth अच्छा करता है, kabhi value अच्छा करता है. So sometimes growth will go up, sometimes growth will come down, sometimes value will go up, sometimes value will come down. The challenge of the question is nobody knows when, right? And therefore, to avoid that, the index gives us a nice platform, because in the index, so if you were to take a Nifty 50 company or an index, you have the 50 companies. Some of these companies in the Nifty 50 could be a growth style, some of these could be a value style. Now, because I'm buying the entire index, I don't have to worry growth chalega ki value chalega, because I have both of them in the basket. Unlike that, in an active fund management, if I were to select, then I have to pick and choose, do I go for growth, do I go for value? Because it is also dependent to some extent on the underlying philosophy that the fund house manages. While these styles will deliver in the medium term to long term, the challenge that most people face is what happens to these styles in the short term. And that is where people tend to panic, and take some knee-jerk reactions, which could be detrimental to wealth creation. So in an index fund, I don't have to worry about abhi value chalega ki nahi chalega, growth chalega ki nahi chalega, because dono mere paas hai as part of the index, right? The fourth important element that index fund provides is is that you're on a permanent autopilot mode. I'm sure most of us would have traveled by flight, and you would know that 80 to 90% of the flight is on an auto mode. It's only 10 to 20% that the pilot and the co-pilot manually do something and intervene. Otherwise, the flight is running on an autopilot mode. Same is the case with an index fund. So when you buy an index fund, you are sort of on an autopilot mode, which means that whatever the market delivers, you should get. So if the market delivers 12% returns, your index fund should also give you close to 12% returns. This may not happen with an actively managed fund. Again, for the sake of repetition, we are not trying to compare active versus passive. We're just trying to highlight what are the benefits of index from an investor's perspective, because most of the time what we have found and observed, and data also supports, is that many investors, especially when they come to actively managed funds, tend to react too quickly, if the markets don't deliver or their particular scheme or fund do not deliver. And there's a knee-jerk reaction, ki isse acha to aur koi option tha. And therefore they try to move out. But when you do an index, you just are worrying about, is the index going to do well? And as long as you're convinced that the index is going to do well, I think index fund suits you very well. And therefore, you get very similar returns to what the market is going to deliver, with some small deviations and variations. Now, just a couple of points on is the Indian indices, Indian market expected to do well? I'm sure most of you also track a lot of these reports, research reports, expert comments. And given the context today, India as a country seems to be in a reasonably good spot, both in terms of on the domestic front as well as in terms of from a global perspective. So we are much better off than most of the countries globally, and the expectation is that the Amrit Kal of 25 years, is going to be very, very rewarding for Indian investors. And if the Indian economy does well, and I'm sure you have seen so many reports of where the Indian economy could be, 30 trillion, 40 trillion, 25 trillion. We don't know honestly, but the fact is that we are on that phase and that path where the Indian economy is expected to grow at a much, much faster pace in the next decade or so. And if that were to happen, clearly equity markets will reward investors who stay invested for that duration of investment time period, right? And therefore, the worry that index investors should only have is India mein bazaar upar jayega ki nahi jayega. As long as you're convinced, I think it's a good option, right? You have understood the benefits of index fund. Let's quickly look at the types of index fund, because so many types of index funds. I will quickly get into some of these. What I've shown here is that what are the broad categories of index funds? What does it try to replicate? And some examples as and where that it is available. So, for example, you have a broad market index fund. As the name suggests, it's a broad market. It's going to replicate the large segment of the stock market. An example of that comes to mind is a Nifty 500 index. So when you look at Nifty 500, you're basically buying or investing in the top 500 companies of the country. And 500 is a huge number because you're now getting exposure to so many sectors and industries and so many market caps in that 500. So you've got large, mid, small, everything is covered in that Nifty 500. So therefore, that represents the broad market index fund. What is more popular is the next category, which is the market capitalization index fund. And again, as the name suggests, is based on market capitalization. And based on the market capitalization, we have shares classified as large caps, mid caps, and small caps. So these index funds will replicate and invest in a specific type of market cap. For example, when you look at a Nifty 50 index fund or the Sensex 30 index fund, they will invest in the 50 companies of Nifty and the 30 companies of Sensex. So these represent the large cap companies, right? You have an option to look at a mid cap index, which could be a Nifty mid cap 150, where you invest in 150 companies that constitute the mid cap segment, right? And then you could have a small cap and so on and so forth. Then we have an equal weighted index fund. Interesting one, because when you look at Nifty 50, so there are 50 companies, and each of these 50 companies could have a different weight. So somebody might have a weight of 10%, somebody might have a weight of 1%. And the fund manager will replicate and copy it the same way. When we talk of an equal weighted index fund, again, let's take an example of Nifty 50. And if it's an equal weighted fund, the 100 rupees is divided in the 50 companies equally. So har company mein 2 rupaya jayega, which means every company will have 2% weightage. So that's an equal weighted index. Another one which is catching up of late is the factor-based index fund or smart beta index fund. So what happens in a smart beta is that essentially the index is constructed using some factors, and some of these factors could be very, very different from the market cap based index funds. So the market cap is very simple, large mid, which is based on the market capitalization. So the smart beta index fund will deviate slightly from that and look at some innovative ways of creating that index. So while smart beta fund is a passive fund, they will bring some element of active selection in terms of the way the stocks are selected. And those active could be by using certain attributes, or factors like a price to earning ratio, or somebody could look at a cash flow or the book value and so on and so forth, and to construct that index. Example of this could be index schemes which is a Nifty 100 quality. So when we say Nifty 100 quality is the attribute, right? And that index is constructed by selecting qualities as one of the parameters or attribute to figure out which are those top 100 companies in terms of quality. We could have a Nifty low volatility 30. So there are 30 companies in the Nifty which have got low volatility. So the low volatility becomes the factor. Now, in the smart beta index funds or factor-based fund, one could have index fund which is based on only one single factor, or there could be multiple factors in the same index. Okay. So while this is an upcoming trend of people wanting to invest into smart beta index fund and so on and so forth, the fact of the matter is that in the Indian context, these are relatively new, and there are not sufficient data in terms of how these funds perform across various market cycles. Okay, but these have their own set of pros and advantages and so on and so forth. Then there are strategy index fund, which will again use some quantitative models and investment strategies. Example of this is the Nifty Dynamic Asset Allocation Index, which will have a mix of Nifty 50 and short duration debt. Then, of course, the simple ones like sector-based index fund, as the name suggests, will invest in a particular sector. Example is a PSU Bank Index Fund, which will replicate the PSU Bank stocks. Then there could be international index funds, which will track international indices. So you could have a NASDAQ index, an S&P 500 index, right? And then very important, again, काफी लोगों को लगता है index fund means equities. While that's the general perception, again, over the last few years, a lot of AMCs have introduced what are called as debt-based index funds, which will track a specific debt index. Okay, and say examples of this could be target maturity funds that are launched. Okay, so essentially, again, very important point in the entire table is that for every set of investor, there is a category of index fund available. Okay, that's what makes index funds a very, very good set of sort of category of funds to look at, right? Quickly, I will touch upon some element of the differentiation between ETFs and index. The reason I'm touching about this element is because when we talk of passives includes both index and ETF. And again, there are some minor differences between both of them. So to sort of quickly explain those differences, again, the objective of the slide is not to communicate and say that index is better or the ETF is better. Both of them have their own advantages and disadvantages, and investor has to decide basis the characteristics and benefits of both these categories, right? So quickly, in terms of the trading style, index fund works exactly like a conventional typical mutual fund. ETFs are exchange traded funds, so they are traded on the stock exchange, and therefore from an operational perspective, they are very similar to shares or stocks. From a liquidity perspective, again, index funds work just like normal mutual fund. They can be brought and sold only to the fund house, okay, and at the day end NAV. That's an important point in index fund. ETFs, on the other hand, because they are traded like stocks, they can be bought and sold through the day, and they could be brought in sold through the day. And therefore, when you buy and sell it, okay, it is important to look at the liquidity element here, because some categories of ETFs, especially a small cap category segment of the ETF, could face challenges in terms of liquidity, right? So one has to be mindful of that, because that's sold on bought and sold on the stock exchange. An important element from a investor perspective is that somebody wants to invest in index fund, just as to be KYC compliant, very similar to mutual fund. You can start investing in index fund. ETFs, on the other hand, will require an investor to have a demat account or the trading and or the trading account, right? So that's a requirement there. While again, in the last 2-3 years, because of COVID, the number of demat accounts in the country has sort of multiplied. What we have not seen in the last 10 years has happened in the last 2 years, right? So a lot of people today would have, majority of investors would have a demat or a trading account. That's a mandatory one in ETF. Ability to time the market, not possible in an index fund, because you're going to buy the units and the NAV is going to be as at the end of the day, right? But in a case of ETF, you may want to try that, entry and exiting in a single day itself. We can do intra-trading and all that, right? NAV is day end. That's an important point in index fund. In ETF, the NAV is real time, okay, because it's live, because the transactions keep happening every moment. The NAV is published live. Tracking errors is an important element in passive funds. Again, relatively, these are the statements that it could be higher than ETF. What we need to understand from an investor perspective is that the tracking error will be much, much lesser in an passive investment, whether that is ETF or index, vis-a-vis an actively managed fund. Minimum investment, again, an important point from an investor perspective. Investor in an index fund, the investor can buy in amounts. What do I mean by this is that I, as an investor, could invest 5,000 rupees, 10,000 rupees, 15,000 rupees, 1 lakh rupee. But when you go to an ETF, you will have to compulsorily buy the unit sizes. So, for example, if you were to buy a gold ETF, you will have to buy minimum 1 unit of that gold ETF, right? You can't say that I will put only 100 rupees. If the unit size is 10,000 rupees, you have to put minimum 10,000 rupees and in multiples of that unit sizes. But in the case of index, you can do 500, 1,000, 10,000, 1 lakh, 10 lakh, whatever you wish to. Another important difference between index and ETF, again, from an investor standpoint, is that in an index fund, you will be able to do SIPs, STPs, and the other systematic transactions like SWPs, which is not possible in an ETF. So if somebody is an investor who wishes to invest in index fund through the SIP route, that's available, that's possible, right? So these are the broad differentiation, active versus passive. We have discussed about it. I will quickly run through it without spending too much time. Maybe 1 or 2 points I would want to highlight. Methodology in an active, very simple. You want to beat the broad market indices. In the passive, you're basically trying to track the index. The philosophy is important. That's where the investor mindset comes and the psychology comes. Investors who invest in active mutual funds, okay, because the philosophy of the active mutual fund is I want to beat the market. मुझे बाजार से ज्यादा रिटर्न बना के देना है, and therefore the philosophy in active is to beat the market. In a passive, I am comfortable with market returns. So the philosophy in a passive fund is I want to meet the returns, right? So that's very important, because from an investor perspective, अगर आपने गलत choice किया, you were comfortable with a market return, you get into active, the risk could be very different. On the other hand, आपको बाजार से ज्यादा रिटर्न चाहिए था, you end up getting into passive, you will be disappointed, right? So that is where the psychology is important, the mindset is important, your objective is important, the purpose of investment is important, right? The other points are fairly similar, so I will not touch upon that element. Just to sort of link both the previous 2 slides, in terms of active index and ETF, one important point is the first point, which is a fund manager bias. And this again happens to be one of the advantages of an index fund and a passive fund, because the fund manager is going to try and replicate what is there in the underlying index. There is no bias. तो फंड मैनेजर को ये चॉइस नहीं करना है कि कौन सा सेक्टर लूं, इज दिस सेक्टर लुकिंग positive, negative, do I go overweight, underweight? Similarly with respect to stocks, should I buy this business or that business? When should I buy, when should I sell? So all those timing elements are also to a large extent taken care of in an index fund, because you just have to replicate the index, right? So there could be some element of active fund, the human bias in an active fund, and that's because that's linked to the objective of the active fund, right? Because the fund manager wants to outperform and beat the market, and obviously you will have to take those calls in terms of going overweight or underweight in a particular sector or a stock. Otherwise, most of the things are fairly straightforward. As I said, the tracking error will be much lower in an active fund, in an index fund and an ETF as compared to an active fund, right? The rest of the things are pretty simple, right? Sort of quickly summarize what we have discussed in terms of the index fund benefits. First and foremost, and this is one of the bigger benefit to an investor, low cost or low fees, right? So what is happening that though low fees is one of the important parameters from an, please understand that with a low fee or the low cost, you're still getting exposure to the market, right? You are still able to diversify across different segments, different businesses, and different market capitalization. That's an important point. Two, we've discussed that there's no bias, overweight, underweight ka tension nahi hai. You don't have to worry about what the fund manager is doing, because it just has to replicate. Third is you get that broad market exposure, as I talked about. Despite the fact that you're paying lower fees, as an investor, you still get exposure to the entire market segment. And important point again is low churn in the portfolio. In an active fund management, the fund manager will have to constantly do those entries and exits. Now, depending on how the market shapes, depending on how the economy shapes up, the fund manager will keep rotating between sectors, moving out of one sector, getting into another sector, moving out of one company, getting into another company. So the transactions could be much higher. The churn in the portfolio could be much higher. In an actively managed fund, in an index fund, the churn is lower, because the index is already constructed, and the index typically is changed only once in 6 months. Right? 6 महीने में एक ही बार चेंज होगा, और फंड मैनेजर को भी अपने पोर्टफोलियो में वही चेंजेस लाने हैं. And then it's also easy to manage from an investor perspective as well as from a fund manager perspective. So these are the benefits of an index fund. Now, since we talked about the webinar as Access, the House of Index Fund, this is some of the offerings in the equity space. I have one more slide which talks about all the offerings. That's important. But here we basically want to highlight that the expense ratio, which we already discussed as an advantage in passives and index fund. Look at the expense ratios. You know, these are typically fraction of what you will get in an actively managed fund, right? And look at the tracking error of all these schemes. Pretty low tracking error, and that's one of the parameters to look at when you select an index fund. So lower the tracking error, better it is, and you will find that most of these schemes have very low tracking error. Now the important point, how do I position it? How do I get passives or index into my portfolio, right? And just as we looked at the example of the auto transmission cars, the manual cars, same concept here in terms of how do you construct the mutual fund portfolio with actively managed funds and index funds. So I'm sure many of us, again, would have at some point in time tasted or eaten a pizza, right? And many of us would continue to do so today also. So when you look at the pizza, you will have a very conventional base of the pizza. That's the largest pie, larger in size. And most of these pizzas, you know, you will have some basic toppings on the top of that base, you know. But as an individual consumer of pizza, we would always tell this guy, you know, that I want some toppings extra over and above the base. I don't think anybody has just the base pizza, right? Everybody has some of the other toppings. Base is what you and I like as an individual, right? So you could have variants in terms of the toppings. You could have black olives, you could have onions, Maybe you could have jalapenos, you could have mushrooms, you could have paneer, you could have capsicum, as all of these as extra toppings over and above your base. And that's precisely what we want to do in investments also. There is something which is a base portfolio, and then you have those toppings, which could be some other set of investments. So how do we put it? Is here we call this as the core and satellite portfolios. The core portfolio is like your base pizza, okay, which is the larger pie. So 70 to 80% of your money could be part of your core portfolio. Now, what could become part of the core portfolio depends on what type of investor you are, right? So in this example, where what I'm showing on the slide is somebody who is who wants actively managed funds, right? And the objective of the investor is to beat and get returns better than the index returns. So for such an investor, the core portfolio, which is the pizza base, could be 70 to 80%, which is actively managed mutual funds. And within that, you will have large, mid, flexi, multi, etc., and so on and so forth. And then you have the satellite portfolio, which is the extra toppings. Now, because you already have an exposure of base, which is 70 to 18 active, you diversify and have passively managed funds as the satellite portfolio. So the remaining 20%, 30% could have your index funds. Now, what kind of index fund could one look at? So if my base portfolio, which is the core portfolio, has a large cap, a mid cap, and a small cap, maybe I want to take the satellite as an exposure to some sectors, right? So I may want to take an exposure to maybe IT. I want to take an exposure to maybe healthcare, which perhaps may not be largely represented in my base portfolio. So base portfolio में मेरे पास शायद healthcare का weightage बहुत कम होगा, because most of the indices, especially large cap, you will find is skewed towards financial services. So financial services exposure I am anyways getting through the base portfolio. Can I get slightly different exposure to different sectors through the satellite portfolio? That should be the objective of portfolio construction. आप यहाँ पे भी financial service लोगे, वहाँ पे भी banking लोगे, it doesn't make too much of sense, right? So you create a portfolio which is contrasting in nature, the core and the satellite. You could also have some tactical allocation in satellite. Now, what do I mean by tactical allocation? The festive seasons have already started in India, and you will have one of the major festivals coming in November, which is Diwali, right? Now, again, if you, I'm sure many of you read reports, there are talks of gold as a commodity. The prices could continue to go up, while as an asset management company, as an Axis fund house, we don't give any recommendations per se on commodity, but the general reading is that gold is expected to do well, so on and so forth. So if I'm an investor who believes in that story that gold prices could go up in the next 3 to 6 months or 1 year, I can take a tactical allocation here in the satellite portfolio, and out of say 100 rupees, I can put say 10-20 rupees in a gold ETF, or I can take an index fund. Because we are talking of index fund, I can buy what is called as a gold fund. Now, gold ETF, you will have to buy minimum 1 unit of gold, okay? And most asset management companies have a 1 unit which is equivalent to 1 gram. But in an index fund of gold, as I said, I can invest in amounts. I can put 1,000 rupees also. That's the advantage of index fund. So I can take 1,000 rupee, I can do a SIP of say 1,000, 2,000, 3,000, 5,000, 10,000, whatever my limit is, every month into a gold fund and take an allocation to gold. If my thought process is very similar to the reports that gold is expected to do well, right? Similarly, I can take tactical exposure maybe to IT. Again, because IT is currently undervalued, because the last 1 year also IT has not delivered. But if my view is that the next 2 to 3 quarters, IT will start delivering and going up, I would want to take a call today. So these kind of tactical allocations can be done through the satellite portfolio. There could be another set of investors who says that मुझे market जितना return मिले बस हो गया. So in such case, the core portfolio will be passive funds. Okay, 70 to 80% will be index funds. And then I take the 10, 20, 30% exposure satellite through actively managed funds, right? So depending on what is your need, you could have a combination of both core and satellite. Again, to go back to that example, all of them can coexist. A manual transmission car, automatic transmission, a cruise control, everything can coexist because every customer will have their preference. Similarly, though my predominant preference could be to beat the market, core portfolio could be active, satellite could be passives. So both of them can coexist in the portfolio, and it is always advisable. And this is what studies suggests, that when you have a core and satellite portfolio, the overall portfolio tends to be more balanced. And when the portfolio becomes balanced, the investor experience is much better, right? And if the investor experience is better, the longevity of investment also increases. And that's very important, because that is when wealth creation happens, right? So this is how you can sort of merge both the offerings. Now, since we talked about Axis as a house of index fund, these are the offerings from Axis Mutual Fund in the index basket. Very interesting is not only just equity funds. So we have equity, which is Axis Nifty 100 index fund. This is a fund which will replicate the Nifty 100. So Nifty 100 is the top 100 companies in the country. Okay, then we have a Nifty 50, which is the top 50, which is constituting the Nifty 50. Then we have Nifty Next 50. After the first 50, which is Nifty 50, the next set of 50 companies is the Next 50 index. And both these, which is Nifty 50 and the Nifty Next 50, constitutes what is the Nifty 100, right? Then you have, if you want to take an exposure to small cap, you have a small cap 50 index fund. If you want to take an exposure to mid cap, you have a Nifty mid cap 50 index fund. And there's an IT index fund. Again, as I was talking in the earlier slide, if you believe in tactical allocation, you want to take a call on IT as a sector, given the fact that IT has underperformed, and you feel that the next 1.5 to 2 years, IT is expected to bounce back, you can definitely take an exposure to IT index fund, right? Similarly, there are debt offerings in the index space. So these are the examples of the schemes that we currently run. Again, debt, most people in India don't generally invest in debt mutual fund. But again, from an application perspective, I would want to just give an illustration, okay? That say somebody is wanting to buy a property, has already booked a property, and some down payment has happened, and the possession of the property could be, say, in the next 2 to 3 years. So you know that in the next 2 to 3 years, and in the next 2 years or 3 years, when you're going to take the possession of the property, and today there are all these schemes that keep running, that you just pay a down payment today, you don't pay for the next 2 years, and then you just pay the entire amount at the end of 2 years. So in such cases, you can use debt index funds because these are passively managed. These are going to track the underlying index and just replicate the underlying securities. It's a good bet to take, in terms of putting that money in a debt-based index fund, and as that index. So, for example, if you have a 2025 index fund, which will have a maturity of 2025 April. So, if your cash flow meets that particular time frame, I think these are good funds to take exposure to. So, because for certain that at the end of that particular period, that cash flow is going to come back to you. So applications could be many. It could be for children's education. You know that the education, the amount is required for education after 3 years, 4 years. So various application, but please do look at debt funds, debt index funds also as an offering in terms of taking exposure and ensuring that your cash flows are sort of calibrated over the next 2 to 3, 5 years, right? So this is what broadly we wanted to discuss today. So we have already touched upon this Nifty 50, Nifty Next 50, and Nifty 100, right? I think this is what we wanted to share. Thank you, all of you, for your time. I think we can go for any questions, if any, Niranjan. Just give me a moment before I just quickly complete the slides. Just give me a moment, Niranjan.
Yes, sir. Yeah. So thank you, Hari, for this very valuable session and insightful session on passives. I'm sure it has been very helpful for many of them. And yes, there are quite a few questions that are coming up on the chat box. So maybe we'll just take up a few of them, right? I think the first question people are asking is who should invest in index funds? Because most of them are predominantly active investors. Should they also invest, or is it for only my first time investor or for very conservative investors? So who would be the right people to invest?
Okay, I think that's a very a valid question. So when you look at index, it actually can be suitable for the variety of investors. First is they are a very ideal sort of funds for investors who want returns very similar to equity markets without taking too many risks. And while I say without too many risks is in relation to the actively managed funds. So while you do come to equity funds and equity indices, you are in a way taking risk, but relatively you don't want to take too much of risk, or you don't want to experience too much of volatility, right? Too much of volatility is the set of investors who would want to come here, right? Second is that it is also beneficial for investors who are not maybe comfortable in stock picking, who don't really believe in active managed funds. Or it could be also a good investment option for investors who are first-time investors who want to sort of test the market. And therefore, it's better to test the market through an index rather than an actively managed fund. And therefore, such set of investors can definitely look at index funds. And also for existing investors. So you talked about is it also for actively managed fund, and that is what we also emphasized and highlighted in the presentation, that you look at a core and portfolio satellite. While your core could be actively managed funds, you could definitely look at the satellite bit of it through the index fund. So all set of these customers are potential investors, and all of them could look at index funds.
Okay, I think another question someone you're asking is, can we invest? I think I already answered it, but can an investor invest in the index fund via the SIP route?
Yes, so as we mentioned in the presentation, also all the systematic transactions, be it SIP, STPs, SWPs, all of these are possible via the SIP route. And SIP today has sort of become a pseudonym for the MF, right? Most people are not aware that उन्होंने mutual fund किया है, and they say that हमने SIP किया. So SIP is a very popular way, and therefore the index funds also through the SIP route, one can definitely look at from a long-term perspective, accumulating units. And we know that in the long run, it always stands beneficial.
Okay, I think a very interesting question has come up, that we already have ETFs that are there, which are more cheaper than index funds. So why should one look at index funds rather than ETFs?
Okay, so both of them are passive investments, and there are some differences as we highlighted in the presentation as well. In the case of ETF, as I said, in the presentation also, that the sale and purchase of the units happen at market price. Because it's a live transaction that happens, the prices are live, and they call it as it's actually called as INAV. Okay, so it's a market price, and this price could be different from the NAV of the scheme. So that's something that the investor should be wary of. And this price difference, between the live market price and the actual NAV could result in tracking errors and could therefore also impact returns. Again, at no point in time do I want to de-sell ETFs. I'm just trying to give the difference. Why should one look at an index fund? ETFs also require a demat account, which is what we also discussed. If somebody does not have a demat and a trading account, the natural choice is to come to index, because you don't need those demat and trading account. You just have to be KYC compliant. ETFs are traded on the stock exchange, and there's this transaction that keeps happening. Therefore, liquidity could be a challenge again, which I discussed in some segments of ETF, especially maybe a small cap kind of segment, while that could not be the case in an index fund. And of course, the previous question of the ability to do those systematic transactions of SIP, STP, SWPs. So these are some of the reasons why one should look at an index fund. Again, I repeat, I don't want to say that ETF is bad or good or index is bad or good. Both the choices are available. Depending on what the investor preferences are, they should look at those passives.
Okay. I think till now we have been only talking about the pluses of index funds. I'm sure, like every other investment, there would be some negatives. If you could just illustrate some of them or explain some of them in brief.
Okay, again, very important. So one is that while the index does a good job at replicating the index and delivering performance similar to the index, it is if you call it, I talked about the Amul ice cream example, versus the local street ice cream. So very similar to that Amul ice cream, that you get very standardized offerings. So it is in a way inflexible. So as a fund manager, can do nothing, except replicate the underlying index, right? Second, in the case of a market correction or a fall, the fund manager cannot take that call of exiting a particular stock or a sector, which can be done in an actively managed fund, right? And further, the other disadvantage, not a disadvantage, again, this is related to what the investor objective is, that index funds will try and deliver returns which are very similar to the underlying index, and they may not be able to beat the index. I think these are some of the cons of investing in index fund.
Okay, I think one question, final question people are asking would be, what would be the taxation? Is it something different or just like the other investments, the taxation of index funds?
So taxation is basis the underlying. So if it's an equity-based index fund, the taxation goes as per equity funds, which is you have got short-term and long-term. So in the case of short-term, if you buy and sell the index fund before 1 year, it's categorized as short-term. You make a profit, you pay a tax of 15% on the gains. If you sell it after 1 year, it's called long-term. You make a profit, you pay 10%. And just like in the case of equity funds, up to 1 lakh rupee of gains are exempted.
I think we'll just see if there are one more question last. We can just about the fee structure. What are the fees? I think people want to know that if it is said so cheap, so what are the fees that would be charged in an index fund?
So index fund will, they do not have, while index funds do have charges and fees, they are much lower than an actively managed fund, because in an index fund, the fund manager does not do any active stock selection, and therefore the fund management charges become very, very negligible. But there are other costs, which are the operational charges. You could have transaction costs, brokerage costs, etc., which will be there as part of the index fund. But the important thing that people should look at is from an versus and vis-a-vis an actively managed fund, the cost and the fees would be much, much lower in an index fund.
I think we are not having any more questions. So
let me just give me a moment, Nilanjan.
Yes.
Let me also. I think there was one question which I saw some time back. Let me just try and figure that question out.
Yeah, definitely.
So there's one question on the smart beta ETFs and index. I think while I covered as part of this, the question is that future estimation about Indian markets based on history, since our history is limited about these indices. Yes, so as the question also says, so while I talked about smart beta, which is basically going to use factor-based investment, it could be it's a slight variant of the passively managed index fund, in the sense that we talked of index funds being investing and replicating the index. The smart beta funds will use certain factors to construct the index itself, and these factors could be very, very different. So I talked in the types of index fund. You could have some of these factors could be based on price to earning, it could be on book value, it could be cash flow, etc., and so on and so forth. And you could also have funds, which will have only one factor, or that could be multiple factors. So what do I mean by this multiple factors? And is that you could have funds, which would have multiple factors in the same index fund, and the stock selection is done basis those multiple factors. Now, as the question also says, and also said in my presentation, there's while this could be an upcoming trend in India, these are relatively new, and from an experience perspective, these funds have not sort of experienced, too much of market exposure, in the sense that, how do they work out in different cycles is what we will have to actually wait and watch for. But it is an emerging trend and something very fascinating and interesting. Only one data point that I could really figure out was between the one factor versus the multiple factor index fund. The data currently suggests that single factor index funds are much better in terms of performance as compared to the multi-factor based investment. The reason is that a multi-factor typically tries to work on the risk parameter to mitigate and reduce the risk, and therefore, obviously, the performance may not be at par with a single factor one. So this is what the data currently suggests. Again, I repeat, a new segment. We'll have to look for some more years in terms of how this pans out across cycles.
Okay, I think if there are no more questions, then maybe we can.
There's one more interesting question, Niranjan, that are index funds better than stock investing?
Okay, yes.
Let me just quickly take this, because again, last 2-3 years, a lot of people have tried to enter the stock market. This question is a slightly difficult one to answer, honestly, because it is very subjective. Why I say subjective is because if I select a particular stock or a basket of some stocks, and that stocks delivers a better return than the market, then I would want to say that stocks are better than index. But on the other hand, if my stock selection has not been that great and it has not been able to beat the market, or rather it has given me a loss, then I would want to say that index is better. But from a very general perspective, investing in index fund does offer some benefit vis-a-vis direct stock investment. First and foremost, index funds will provide diversification. That's very important, because you take exposure to the entire market index as compared to just a few stocks. So, for example, when you buy a Nifty 50 index fund, you're basically getting exposure to 50 companies. And these are companies which are spanning different industries and sectors of the economy. As an individual investor, there could be limitations in terms of how many companies you and I could personally hold in the portfolio, right? And further, when you invest in an index fund, you also need not worry about the timing per se, in terms of when do I enter or exit that particular stock, because in a stock investment, it does become critical and important. The selection of stock is also not what I have to do in an index, because that's done by the index itself, and the index will do that auto correction. When I say auto correction, if a particular stock which is part of the index no longer qualifies the criteria, it will exit that index, and a new company would substitute it. So that is done automatically. So again, as an investor in an index fund, I don't have to worry about it, right? So entry exit timings do not make too much of so while in individual stock selection and investment, it could be important. An index fund, it is not very important, because I don't have to worry about it. The third is in a stock selection, while I might have selected a few stocks, earlier we used to say that, equity mein paise dal ke bhul jao. So, but today it's imperative that when you invest in a business, you also track what is happening to that business, because we have seen that companies which were actually number one companies having monopoly, some of them don't exist today, right? So it is important that investors who invest in stock market also look at what is happening to the business in terms of the sales, in terms of the profits. So all those things is critical in stock selection. In index, I really don't have to worry about all that, right? So these are some of the things, where that index offers as a benefit vis-a-vis direct stock selection. But before I end the answer, again, if you are an investor who are comfortable selecting stocks, and you have the acumen to pick and select and choose stocks, you could continue to do that. Majority of investors and individuals find it very, very difficult to do that. And therefore, the better way to participate is to come via the index fund.
So I think we have no more questions right now. So we shall conclude the session. So thank you, Hari, for a very, very insightful session on passives and on index funds. Just
Thanks.
before concluding, a small trivia that the pioneer of index funds, global funds, it was Vanguard, right? In US, it was founded in the 1970s. Today, their largest passive fund, which is the S&P 500 fund, which tracks the S&P 500 in the US, I think it's an AUM of over $700 billion, close to $1 trillion. So that is the size and potential which also we have. So thank you, people. I hope you've had a very valuable session. Continue to have such sessions going ahead. Enjoy investing. Thank you, sir.
Thank you, all of you. Namaskar.
Thank you. Namaste.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.